Smart money concepts. A very powerful school of thought, a very popular school of thought. And if you are someone that follows the school of thought of ICT, very similar to SMC, you're going to be one of millions of traders that trade in the same way. And look, 5 years ago, I used to be trading SMC and I used to find it very powerful. Years ago, it was very respected, higher time frame, smart money zones, implementation even of smart money concepts on a lower time frame was yielding profitability. But fast forward to the present date, 2024, smart money concepts is not the same. And not only is it becoming less reliable. In fact, I believe it's getting targeted. I believe the rise in popularity of SMC, where millions of retail traders all across the world are trading in the same way, that has led to the algorithm changing, the market movements developing, leading to a new piece of evidence we see in the markets called smart money traps. Now, if you're not a believer in smart money traps, hey, don't shoot the messenger. Look at the evidences in the market. And what I'm going to do in this video is go through the last month of price action and show you how often and how repeatable these smart money zones are getting targeted and induced. Meaning to say, smart money traps exist, and I'm going to show you in this video. And now, if you're a skeptic and someone that believes truly in SMC, you are a ride or die SMC trader, you would have seen my previous videos where I've shown a catalog of evidence to prove smart money traps are real, to prove that smart money concepts are getting targeted. And I don't just come with an opinion and a theory. No, I come with market evidence. And if you remember, for the last 7 months, the public signals that I've been calling, where I've given every single entry, stop loss, and take profit level live ahead of time for months on end and documented 55+% gain, majority of these trades were actively trading against smart money concepts. Now look, I have no personal agenda. I don't have a personal preference. I just trade in a way that makes sense. And when smart money concepts served me, I utilized it. Now when smart money concepts does not serve me, I utilize what's working next. And if you can think, well, why would the market change? I don't know. All I can see is it has changed. And if we think about it, with the rise of technology, how the world has changed in just the last 5 years, with the rise of AI, machine learning, billions of dollars invested by funds and institutions into tech, data analysts, quants, it's no surprise that there's innovations all the time. And therefore, as a result of this, to have a competitive edge in the market, new strategies are always being birthed. New approaches are always being birthed. And therefore, new participants and new ways of participating in the market are always being birthed. So going through the last month of price action to show you all of the smart money traps and the smart money zones getting induced, and then showing you correct inducements. And what you'll start to realize, they look very similar. The formation is very similar, and sometimes it can be hard to differentiate. So before we get into how to navigate all of this, I'm going to give you a key so you can start to understand how I'm going to mark everything so that we can navigate everything, that we're on the same page. So these are the only things I'm going to mark on the screen. A blue box is going to denote a demand area. A red box is going to denote a supply area. A purple box is going to denote a smart money trap zone. And this is exactly what we're going to focus on. And the reason we're going to do it like this is because smart money traps and smart money zones often interact with supply and demand areas, and often market structure traders that are reading market structure incorrectly, looking at weak supplies or invalid demand areas, layering it with smart money concepts will lead to these false zones, or therefore smart money trap zones. And then the red box is going to highlight the correct move, the correct inducement, the last move in the market that grabbed liquidity before an impulse. And lastly, the dotted purple line to denote liquidity pools. Now we need to establish a commonality on how we can read smart money concepts. Now I'm not going to try and summarize the entirety of smart money concepts in a few sentences. However, it's important to recognize how smart money traders think. Now, smart money traders are going to be utilizing a lot of things, and this can come into the power of three. This can be imbalances, inefficiencies, order blocks, breaker blocks, and there's other types. For example, the silver bullet or the turtle soup. There's many ways we can look at it, but smart money concepts in general pins upon a few key factors. One of them is going to be liquidity, and therefore we'll have buy side and sell side liquidity, and therefore the interactions of those liquidity pools known as sweeps. So when we have an interaction of a liquidity pool and a sweep of a liquidity pool during, let's say, a London session, the kill zones of smart money concepts, this is where they are going to be looking for points of interest and therefore trade positions. To put that in perspective, let's say you have a zone of consolidation or a zone of equal highs, like so. So you'll mark out these equal highs. Smart money traders will identify this as a pool of liquidity. Thereafter, when smart money concepts are starting to see a raid of that liquidity, a sweep of that liquidity, particularly during a meaningful moment in time, let's say a London session, then we'll start to see a bearish reaction off that zone. Then once they see a bearish reaction off that zone, they will start to look for a sell position accordingly. So they will essentially look at this build-up of equal high liquidity, a sweep of that liquidity, and therefore trading in that supply zone, like so. And therefore the short position they'll look to trade is based on different types of entries, but essentially they're going to be trading in line with something like this. And to be honest, this kind of modeling is not terrible. In fact, it can be quite reliable if you correctly identify the meaningful inducements versus a smart money trap. Then you are actually heading in the right direction in my belief. However, the entry points is important and the invalidations are equally as important. To summarize how they may entering, so we will look for a buildup of liquidity, we'll look for a sweep, we'll look for relevant time, and then they may add in the entry requirement, which will be an imbalance. It might be a optimal trade entry, therefore a Fibonacci level, maybe an order block, maybe a breaker block. So there's going to be various ways you execute upon that, but this is the general formation where we have equal highs, run of liquidity, and then entry. And that entry is based on a mitigation. So this is the smart money zone. Now, what I've often found is, and what I'm going to prove to you in this video, is how this area can be quite manipulated. So it will look similar in fashion. We'll have a build up, we'll have a sweep. But the key here is, for example, one of the ways to identify a smart money trap is price comes to the previous demand area. Now, this demand area can be a typical support level, or it can just be a valid demand area. But this is going to be an invalidation, because if we look at it from a market structure perspective, we have a higher low, we have a higher high, we have a higher low, we have a higher high, we have a higher low. Maybe we should go on to make a higher high. So therefore, when the market doesn't follow the smart money patterns, we can simply say, okay, this is the last higher low that made a higher high. We had a bullish expansion. Therefore, we should have a push down and a continuation up. So smart money traders are therefore trading against that. So we have to counteract that narrative and say, if this is going to bring me doubt, a counter demand area, then I need to wait for confirmation. And to be honest, if you think about it, if you're having a real run of liquidity, if this is real equal highs, if this is a real sweep happening, then you've grabbed liquidity in the market. And the law of cause and effect should state that if you have a cause and a catalyst, which is a sweep of liquidity, this newfound liquidity should lead to a reaction. That reaction should be a break of structure at least. That will be the strongest way to identify where we've had a reaction, a cause and an effect. So if we have a cause, which is a sweep, and then we don't have a reaction, we just come to demand, that is not showing true intent. And therefore, that's a signature that there's a lack of intention, therefore a lack of liquidity in the market. So there'll be many ways you can identify a smart money trap, but the weakness you can start to see how it will present. Now we can start to see that this pattern, which SMC traders often fall into the pattern game, they'll have this same price action, price coming into the entry, the optimal trade entry, the Fibonacci level, the order block. You might even get a false reaction, and then you might get a push up. So in this case, this is going to be a manipulation event, and you're going to have a series of manipulation events. First of all, this resistance level, you got the breakout traders going break, test, continuation. So those breakout traders' liquidity was in this area. Those people got taken out with this move. Further to that, upon a resistance level, you have buy stops triggered. So you're going to have buy stops triggering, and therefore their liquidity of stop losses below. Moreover, you're going to have market structure traders that are going to be seeing this bullish push out, maybe entering on this demand area, their liquidity resting below. And then you have this trend line forming, the liquidity associated with that. So this move over here not only is doing an inducement of existing liquidity of the smart money traders whose stop loss was right here, and also the breakout traders who got manipulated in these areas, you're also generating liquidity based on this bullish price action where we have higher high, higher low, higher high. Buyers are getting in. They're going to be getting in on this demand area right here upon a trend line within this zone. So we know all over here we have more and more liquidity forming. A real inducement is going to be inviting people to get in and taking stop losses. It's both. That is the maximum catalyst you can have, because you're gaining liquidity and you are generating further liquidity so that when the real move happens, it's a powerful, intenseful move. And the signatures of that will be large bearish momentum, large bearish candles, large imbalances, breaks of structure for sure. And that's the sign of a real move with the law of cause and effect. So therefore, what we'll start to see is this pattern is going to fail, and pattern traders certainly should be looking to elevate their trading to look away from patterns and rather try and understand price action for what it truly is. If this is to happen and price then eventually goes on to make a lower low, it breaks structure and does everything we were thinking it was going to do. This area became a smart money trap, and therefore this trade of smart money traders was invalidated and hit stop loss. This is what we really need to look at. This is going to be one formation of a smart money trap movement where that was the real inducement and we had major liquidity events. So this is just looking at it from one time frame, and therefore the only immediate liquidity that we can see, let alone the higher time frame, multi-time frame liquidity we could grab. But the trend line traders buying upon this bullish price action, higher high, higher low, higher high. The real bearish move took those traders out. So we enticed them and then induced them. Second of all, the equal highs, run of liquidity, smart money traders reaction, those people got taken out. The early sellers and the trendline sellers got taken out. The break retest traders got taken out. This is a mass liquidation event, and therefore after that, you should have the real meaningful move. So we need to start to understand how we can not only take the real smart money zones, the valid inducements in line with smart money concepts. I'm not saying smart money concepts is wrong. I'm not saying avoid at all costs. I'm saying be able to differentiate between a real inducement in line line with smart money thinking, and also inducements that are not in line with smart money thinking, because that is starting to differentiate. And I can also take a trade like this, but I'll also take a trade like this. And the key is knowing the difference on when it's a smart money trap and when it's a real inducement, because they will appear similar. In fact, a liquidity cycle is a similar key. It's a buildup of liquidity, it's an inducement of liquidity, and the mitigation is the entry. So very in line with SMC, the key being context, narrative, multi-time frame analysis, and traps. And smart money concepts, unfortunately or fortunately, depend how you use it, is a trap now, and we can use it to our favor. So noticing the difference between the two, we should be able to trade not only the smart money zone, but also the inducement zone like this, and therefore be able to capitalize on both. And in this video, I'm going to show you examples of both. And this video is supposed to give you questions. It's supposed to plant seeds of thought. And I want you to go ahead and explore, experiment, backtest, and find answers for yourself. And I'm going to point you in the right direction in this video and enforce it with evidence after evidence of recent price action. In this case, I'm going to cover GBP USD and go through the last month to show you case by case. So at the time of recording today, it is the 24th, and therefore I'm going to go back to the 25th, 24th from 1 month ago, and let's do a rewind together of the last month and look at all of these zones we'll be interested in. To avoid too much complexity and over-explaining things, we'll stick on the 5-minute time frame, but as you can imagine, multi-time frame analysis is crucial, and multi-time frame analysis will bring more and more of the same reinforcement. So let's stick with one time frame, but then go ahead and backtest to see how the multi-time frames reinforce exactly what I'm going to say. But the 5 minutes should be enough to demonstrate the point I want to make. In line with the smart money pattern, and I'm going to be very rigid with it. I'm going to avoid the other context that smart money traders think about. For example, time, for example, lower time frame confirmation, for example, I don't know, the OTEs and the different type of breaker blocks. There will always be an excuse from a smart money trader to say, oh, I wouldn't do that. Let's ignore that and follow the principle, follow the buildup of liquidity of equal highs, the sweep, and therefore how that is starting to fail. So let's go case by case. So 1 month ago to the day, basically, we had this buildup of highs. We had this trend line, we had these equal highs, then we had a move up, a sweep. Now that sweep, if we focus on it, is time relevant. That sweep is time relevant because not only is it a sweep of Asia high liquidity and relative highs from previous price action, it is happening in a meaningful moment that is Frankfurt Open. So if we're getting a Frankfurt Open move, sweep of Asia highs, sweep of equal highs, this would entice smart money traders, especially after getting this break of structure. So we have a sweep of liquidity and then a bearish reaction. So smart money traders will be looking to get entries upon this breaker block, let's say, and we can even see the wicks of the reaction, and more importantly, upon this imbalance inefficiency zone or order block. So we can start to see this would entice smart money traders to get in, but then notice how we have the price coming higher, taking out the smart money traders liquidity, doing the inducement, and then having the real move. So this is going to be starting to build questions for you, and case by case by case, you'll start to unveil what is the reality. Now we can start to also see how the inducements come into play, because we can also say, oh, we had a buildup of liquidity here, very small amount. We had this sweep of liquidity right here, price came in, and then what did it do? Induce the level. So I'm not going to call this a smart money trap entirely, but it's the similar principle. How we had a smart money potential zone because we had a small buildup of liquidity right here. So equal lows, run of liquidity, price coming in. What does it do again? Generates more equal lows on a 1 minute time frame and then induces them all out. So therefore we had smart money trap sweep, real inducement, and this real inducement taking out maybe this zone was the catalyst to fuel price higher, to initiate the movement, to take out the smart money traders, to have the liquidity to take out the smart money traders. Once that happened, this inducement led to the real inducement of the day, and therefore this area that maybe enticed smart money traders to get in, I don't know if they were getting in on this liquidity, we give them a false reaction and then we take them out. So this is going to be a repeating and reoccurring pattern that I want you to take heed of. Same thing again, we have this equal lows, this potential trend line, we have a potential support level of liquidity. What happens thereafter? We have a run of liquidity like so, and that run of liquidity leads to a push out, leads to a break of structure and so forth. So we can start to call this an inducement. A buildup of liquidity led to a run of liquidity, led to a reaction. Now, where did that reaction go to? We had a bullish push out, but price didn't start a bearish trend from here to form higher highs. No, price follows the context of what's more important, not just build up in inducements and zones, rather the narrative of the day. So we had the inducement of the day after the smart money trap, and that zone was respected. That's the zone price went to. Even after an inducement low, price came to the zone it needed to. That's following the narrative and respected it altogether. Okay, moving on, we can start to see how that became the inducement not only of the day, but held for even the following day and started to generate a bearish trend. Take note of this supply zone. It's going to be interesting later on, but it's a zone that potentially grabbed liquidity, a very small amount, or it's a supply zone that led to a lower low. It's a lower high that led to a lower low. Price goes down all the way to here. And I notice, okay, what's happening here? So let's notice what happened in this demand area. So this demand area led to the bullish push out, what we just terminated. We start to notice similar things are happening. We have a buildup of liquidity here. We have a run of liquidity inducement. We even have an internal mitigation, and then price starts to push higher. Interesting to see. What does it do? It generates liquidity first. Interesting to see. We have this level. We have this run of liquidity. So it's supporting the inducement. This level is supporting this one. This level is supporting this one. This one is leading the show. So this is the inducement, the one with control. And therefore these inducements are fuel to target not only breaks of structure, but other liquidity pools. So we're starting to see that this inducement led to this push out. This inducement and this mitigation of this demand led to the next push out. So this zone was an accumulation altogether because we had the inducement and then we had the expansion. And then when prices revisited it, this became a smart money trap. So we follow it forward and we see how does price come into it. Price comes into that zone where smart money traders will be interested because it was a zone that had a run of liquidity and led to an expansion. Price came in, tapped in, gave a reaction, invited them in, showed an M1 trend line, invited these buyers in, and then quickly took them out. So why is this happening? Why are certain zones respecting and certain zones not? This is a question for you. This is important for you to recognize. And we can start to see, well, narrative, and we start to ask ourselves, maybe narrative is important. Maybe narrative is the most important because this inducement over here that not only took out this zone, but the internal zones within is leading the show, not only forming a new trend and therefore a bearish market with lower highs and lower lows, not only revealing supply zones, so market structure and trend traders are satisfied, but also against smart money zones. So we have to see why certain things are happening in this way and not just the laws of smart money or not just the laws of supply and demand and market structure. Rather, it's a combination where at times all of them work, but how you combine them and the narrative is the most crucial thing. So we see that false reaction on that zone, it comes up and then takes them out. Now what's happening just the next day after? We have a buildup of equal lows. After inducing that zone, we have a real inducement over here that fuels a push higher. So now we're starting to see, okay, is this the new inducement that is going to lead the show? Inducement leads to a push out. We now have a high in the market. We can start to see how that high in the market maybe left some liquidity right here that we can start to target. And then when we have the buildup of these equal lows, the inducement low, we start to have the new expansion out. So this is also happening in a meaningful time during a London session. But why did this one hold? And why was this one not like the previous day, a smart money zone? Ask yourself these questions because we could also say, oh, maybe there's a buildup of liquidity like so. Maybe there's a liquidity pool over here, and we can start to see how this liquidity overall got induced. Break of structure bearish, taking out this level. Are smart money traders going to get in here? Is that a smart money trap? But what we can really see is what's leading the show. This inducement low pushed the markets higher. Then we arrive to that previous supply zone. What happens? The market does a minor inducement when? In our key window. Notice how I have this gray box on the WWA indicator, something I coded for myself to use to note key moments in the day, not key moments of entries. Not all of these are for entries. You need to know when is liquidation time, when is entry time, when is manipulation time, what are liquidity pools, for example, Asia high, Asia low. I coded this for myself to help me, to aid me in visualizing price. And we can see in the meaningful window, we have a build up, we have an inducement into supply, and then the real reaction. And that real reaction took out the previous inducement zone. So we have to see inducement zones are happening, but they're not always respecting either. So we need to know the types of inducements, medium, minor, major, when those minor, medium, and major inducement zones become valid points of interest, structurally aligned or context aligned, and when these zones become liquidity and targets for smart money traps. So for example, over here, if a smart money trader was interested on this demand area, and would they be foolish to think about that? Or you tell me, if we have a buildup of liquidity here, a run of liquidity, a sweep for smart money traders, and then a push out, and then price comes back, gives a false reaction, smart money traders might get induced here. They might get liquidated when price comes lower. So that could be another form of a smart money trap. Not something I'll consider because it's quite out of hours. I don't think smart money traders are usually trading the Asia range. When we identify the real inducement, it leads the show. This inducement into supply leads the show. Coming into the next day, we have lows left in Asia range, interesting to note, and highs left around Asia range, interesting to note. What happens? The next day, the market comes open, and during our London window, we get a sweep of those equal highs, equal low liquidity to target, and during the London window, we get a run of liquidity of Asia high, of this equal highs also. And once we have that sweep, during the Smart Money Concepts ICT kill zone, we also get a break of structure. Low. So smart money traders will certainly be entering on the optimal trade entry, maybe on this breaker block, whatever order block, whatever reason they're going to get in, they're going to enter and then they eventually get induced. Price comes higher. So they were wrong and the real move was this potential minor inducement to fuel the market to come higher. Now the market comes higher, takes those smart money traders out and goes to the next liquidity pool, potentially this trend line. What do? We get an inducement of that. So we have another highs, we have another run of liquidity sweep, bearish push down. Even we can see a break of structure over here, an internal break of structure to form a lower low relative to this higher low. And then smart money traders get induced again. So we can start to see there was smart money trap, real inducement. We need to know how to identify that so we don't get caught up in these areas. Then when we have New York open, the manipulation, probably a news event, then the key window I trade, we start to see the real move presenting, targeting these lows that were generated, utilizing the smart money traders liquidity and targeting the next pools, this one over here and the Asia low pool. Now what happens next on my next marker of time, London close, we have another inducement. But what happened over here that we can notice? Well, smart money traders liquidity was useful once again. We had these pip perfect equal lows. We had a sweep like so. This is happening during New York open. During the first hours of New York, we get a push out. Smart money traders are potentially loading up on this demand area because it took equal lows. We had a push out and maybe even people getting in. And those smart money traders, if they are present, are getting induced once again. Asia low liquidity, equal lows liquidity, and smart money trap liquidity, all induced on London close, one of my key time markers, and then the real move happens thereafter. So once that liquidity is grabbed, then we target the next one. We target these equal highs. Now we have equal highs. What happens? Smart money traders potentially seeing that sweep. They fail to recognize the demand area, and then they also get induced once again. So it's not about picking, being perfect on each smart money zone. Maybe not you as a smart money trader are taking each one of these zones, but notice the evidence. Notice how it's building up liquidity, sweeping it, giving a false reaction, and then the real inducement. So it's getting some people in. Maybe not smart money traders alone. Maybe you have breakout traders, maybe you have market structure traders. All types of traders are getting manipulated on these movements. So we have to understand it's crucial. You have to read the market correctly, and these things will only guide you. Then we have the real inducement of the session that led to that supply zone, then has after this smart money trap, the inducement, and then a move down. Now that inducement has fulfilled its purpose. Then these are leading the show again. So this one followed by this one. Build up of liquidity, if you want to even call it lows, more so like a trend line. Inducement, mitigation, and then the market moves higher. So context was important once again to notice the real inducements from the purple boxes of smart money traps. Moving over into the future, just the next day, we're doing day by day. It's literally every single day there's something important to notice. We have over here, build up of liquidity, trend line coming in during a London session, traders interacting with it, New York open, right over here on the minute, reaction of this trend line, and we're seeing breaks of structure, lower low, lower low. So there's going to be liquidity around this area. And never mind the higher time frame, but I'm sure there's going to be some levels on the left that we're interacting with, but we notice this run of liquidity that leads to a push down. So it became a build up of this trend line, inducement of this trend line during our New York window, and then forming a lower low. So that became a meaningful inducement. Next, what happens? Price then starts to react with these previous levels, and notice how the previous level that has got induced, the smart money trap that got induced, and the real demand respected. Let's investigate that. What happened here? This previous zone that led to a push out that grabbed liquidity ended up failing, and this blue one ended up being respected, like so. So this equal lows, run of liquidity, push out, respected, but the next one, equal lows, run of liquidity, push out, got disrespected, did not honor that zone. So we need to understand smart money traps versus real zones, even if it's in a key window. During our London open, it can be the make or break. If you don't understand valid zones, you'll start to enter here, maybe take a loss, and then enter on the valid one. So you maybe get the trade in the end, but you could have avoided a loss. And there's going to be many ways that we can start to navigate this, but it's food for thought for today. Understand these zones. Next day, well, we can also see this previous smart money zone that I marked out, the one that induced all of this, early sellers, trend line, inducement, push down, price revisited, and it doesn't blow through it always. It invites people to get in again with this trend line, with this push down, this internal break of structure like so. So we're inviting liquidity and then eventually taking it out. And what's leading the show is going to be inducements as always. So eventually we come higher and higher, and we tap into a higher time frame supply. So we notice that we start to get rejection. We start to get this trend line. We start to get bearish price action happening. So we can mark this level and see what's happening with this level. So interesting. We have our Asia range happening, our London session, New York session starting, and during the New York session on the London close, we have build up of liquidity equal highs, a run of liquidity like so on a supply zone that is reacting off a previous supply zone, bearish reactions, price retracing, giving the sweep that smart money traders would be interested in potentially, giving consolidation, and then eventually taking them out. So we need to understand this. Again, I'm not saying each example is perfect, but notice the evidence. Don't shoot the messenger. We don't have to get into the whats and whys. We just have to notice it. We just have to see and use it to our advantage. Same Same the next day. We have a build-up of liquidity here, equal lows. We have a run of liquidity. When is that happening? Perfectly on London Open, an ICT SMC kill zone. Then what happens? The push out. So the push out is happening. Therefore, buyers are going to be looking at this as a demand area. It's a sweep zone that led to a bullish break. People are going to be looking at that order block, optimal trade entry, and so forth. Price does push up, but it does so after grabbing their liquidity, after a inducement of a smart money zone. Evidence after evidence. So smart money trap, smart money trap. Moving over to the next day. Once again, we have equal high is perfect. We have a sweep. We have a bearish break of structure. Smart money traders interested, false reaction, and then swept out. So let's do that again. Equal highs, smart money zone, bearish break of structure because this is the last higher low that made the higher high, goes on to make a lower low, bearish reaction. So bearish break of structure, retracement, optimal trade entry, breaker block, order block, false reaction, inducement out. Smart money traders potentially getting taken out. Now, once we had the smart money trap to the high, it looks like we have another one to the low. Equal lows, run of liquidity during the London window, push out. Price then comes back to that area, gives a false reaction. So sweep zone, like so, false reaction number one to entice more people to get in, and then eventually getting induced. So we can see time and time again, even these equal lows right here, those pip perfect equal lows induced two smart money traps potentially. Narrative was king, and then the real inducement happened over here. Now this is an interesting one because we have a lot of liquidity events happening where we have this potential trend line, we have this potential trend line like so, we have this previous smart money zone inducement, so we can start to see prices chopping around. But these things are not random. They are enticing people in and inducing them out. The market runs on liquidity, so if sometimes the market will need to generate liquidity, and we can see over here this run of liquidity of this trend line of this level was significant. Cause and effect. The cause, which was the sweep, led to an effect, which was the bullish breakout. But that also grabbed liquidity. The effect became the next cause. So we grabbed all of this trendline liquidity, even this smart money zone liquidity. If I am to mark it out, equal highs, smart money traders interested in this sweep and potentially getting taken out. So use this to your advantage. Focus on what's happening. Focus on what the market is showing you and learn from the evidence of price. This inducement low, which grabbed all of this fuel, pushed the market higher. Along the way, generated a trap. Next, market has come higher, swept all of this liquidity, swept the smart money trap. This becomes a new catalyst, a new cause, and therefore leads to a bearish break. And therefore, once we've had that bearish break, price comes back to the supply zone of it and honors it. So we mark that out. On a day like this, for example, where you're having liquidity generated, trend lines, support, resistance, equal highs, equal lows, sweeps, runs of liquidity, smart money traps, there's a lot going on and it's happening at meaningful times too. So if you don't know how to navigate this correctly, on a day like this, you'll get lost with market structure, you'll get lost with supply and demand, you'll get lost with smart money concepts, and what led the show was the correct inducements. We have to understand these things to navigate the market correctly. And also, not all inducement zones lead to POIs. For example, this inducement low that led to the bullish push out did not lead to a demand area. It did not lead to an entry over here and for us to look for buys. But maybe some people that were thinking that, where we had this demand area and the market pushed out, maybe those traders had a stop loss hunt right here. Maybe that was an inducement of those kind of traders. Maybe let's mark that out. But we can see the market can get confusing if you rely on only one thing. If you only rely on market structure, if you only rely on smart money concepts, if you only rely on supply and demand, even if you combine them, it will lead to a lot of wins. It might even lead to profitability, but you're not getting the full picture. You're not fully understanding it until you understand inducements, because inducements overpowers all of them, because liquidity is the fuel and the essence of the market. So if you look at the market from first principles, what truly drives price, and then you add market structure, smart money concepts, supply and demand, and other factors on top of that base, then you have a solid house. But if you only have the smart money concepts and the supply and demand and the market structure without the foundation of inducements, it will always be a shaky building. Okay, so as we can start to see, there's a lot going on and there's a lot to take in. And I'm not doing a full guide in this video alone. This video is to show you what you maybe don't know, to identify and plant seeds for your own curiosity, for your own backtesting, to look for answers. In future videos, I will develop this. I will show you how to utilize it, how to identify correctly between real smart money zones and inducements. You have to differentiate that. And then how to apply these things correctly with market structure, correctly with supply and demand, and therefore narrative building, inducement of the day, confluence hierarchy. These are all things that you have to develop to truly be a professional trader. And if you are someone that takes your trading seriously, if you are truly trying to get profitable and you really put in the work, go ahead and backtest this. Pick any currency pair, pick the M5 time frame, and just rewind for 1 month, any currency pair, and go back for 1 month and notice what I'm showing you today, and notice how often it is. This is this month's price action on GU, and I've shown you at least 10 examples in the last 20-30 days. You can do this on every currency pair. And if you can start to identify how to use this to your advantage, have rules in place, make it mechanical, and look at the market from inducements, you will always be step ahead. And remember, this was just a loose explanation. I didn't put in all the rules in place, neither for the way I trade, neither for the way of smart money traders. It's just exemplifying an example. However, once you put in rules in place, this will turn from ideas to setups and high confluence setups, and therefore the restrictions will always lead you. And that's why I always say a restricted trader is a profitable trader.